Hi, I'm Brenna Surette, Associate Wealth Advisor with Burney Wealth Management. Now that we're at the halfway point of the year, it's time to focus in on some mid-year tax considerations. I know it might feel like you just filed your 2020 return, but dedicating time for mid-year tax planning can help save on your 2021 tax bill and eliminate surprises when it comes time to file next year. I'm going to cover a few tax planning considerations that we like to implement with our clients, broken out into 2 steps. Let's get started. The first step is reflecting on and learning from your most recent tax return. A detailed analysis should reveal any missed tax savings opportunities or areas for improvement. Let's break down specific areas that you and your trusted tax or financial advisor should understand. To start, you should review your marginal tax bracket. In the United States, we have a progressive tax system, which means different levels of income are taxed at different rates. Your marginal tax rate is the rate that you would pay if you earned an additional $1 of income. So looking at your tax return, which bracket did you fall into for the year? Do you anticipate a change in your income for 2021? This is important because a change in income could mean a change in your marginal tax bracket, and that might mean several things. You may qualify for certain deductions or credits that you weren't eligible for before. You may want to consider certain opportunities that might make sense, such as a Roth Conversion, and you may need to change your withholdings from your paycheck or estimated quarterly payments. The next item to review from your tax return is your tax rate on investment income. More specifically, what tax rate did you pay on your qualified dividends and capital gains? And is your portfolio as tax efficient as it could be? Many investors aren't aware that there are several tax brackets for capital gains. This is important to know when it comes to making decisions on how to invest inside of your portfolio and when to take action with your investments throughout the year. Your marginal tax rate might also come in handy again when it comes to evaluating how tax efficient your investments are. Are you holding the right types of investments in the appropriate accounts based on tax treatment? Next up is deductions. Did you itemize or pay the standard deduction? This is important because understanding how close you are to itemizing versus taking the standard deduction might lead you to take certain tax saving action this year versus next year. For example, someone who's about to retire next year and subsequently see their earned income and tax rate drop might decide to accelerate several years of planned charitable giving into the year before retirement to take advantage of itemizing charitable deductions in a higher tax year. An important note is that your tax analysis should serve as a reference point throughout the year and should be revisited as your situation changes. Now that we've covered step 1 of reviewing your tax return, we can move into step 2, which is mid-year tax projections. The goal of a tax projection is to estimate your income tax liability based on your potential future life changes or investment activity. Some questions to ask yourself are, do you anticipate a big raise? Are you transitioning to retirement soon? Did you need to realize a large capital gain this year from the sale of an investment or a business? Changes in income are an important tipping point for knowing when taking certain actions might improve your future tax situation. Here are a few common strategies and tips related to tax projections that we like to discuss with our clients. Number 1 is Roth Conversions, and Roth Conversions involve transferring funds from a pre-tax retirement account into a Roth retirement account. When you do this, you'll need to pay federal and state taxes on the amount converted and also be mindful of certain restrictions, but once inside of the Roth account, the funds will grow tax deferred and be eligible for tax-free withdrawals in the future. Every situation is unique and there are several reasons to consider a conversion, but generally if you expect your tax rate to be higher in the future, it makes sense to consider taking action. Moving on to number 2, we have managing required minimum distributions or RMDs. And while you didn't have to worry about taking your RMD last year due to the CARES Act, you will definitely want to make sure you take your distribution before the end of this year to avoid a hefty 50% penalty. Remember, RMDs may push you into a higher tax bracket than expected. We covered Roth Conversions a bit as a helpful strategy to reduce this potential future tax obligation, but another strategy you may want to take advantage of is a qualified charitable distribution or QCD. So a QCD is a direct transfer of funds from your IRA to a qualified charity, and this distribution will be excluded from your taxable income, making it a great way to lower your tax burden while supporting an important cause at the same time. And lastly, at number 3, we have enhanced charitable deductions. So the Consolidated Appropriations Act extended numerous provisions from the CARES Act into 2021, including the enhanced charitable deductions. And what this means is that for those who itemize, the annual limit on deductions is increased to 100% of adjusted gross income for certain charitable cash contributions. For those who don't itemize, you can still take deductions of up to $300 for cash charitable contributions made to certain charitable organizations or $600 for those married filing jointly. And of course, tax strategies like the ones mentioned throughout this video should be considered in the context of a comprehensive financial plan. Be sure to talk with your tax, legal, and financial advisor to determine if any of these strategies make sense for you and your unique situation.